A government convoy in Nairobi rushed through traffic just after dawn, carrying sealed documents marked urgent currency directive. Inside was a single instruction. China's yuan would now settle the country's next wave of infrastructure payments immediately. Before officials could process it, Brazil's agriculture ministry issued its own alert. Soybean exporters were being asked to prepare yuan clearing protocols for shipments bound for Chinese ports. Then the shock spread further. In Johannesburg, engineers at a major development site found their new financing tranche had arrived overnight, not in dollars, but entirely in yuan. And as these countries scrambled to understand the link, BRICS leaders issued the announcement that turned confusion into global tension. A new payment system, claiming reach across 185 countries, had been activated. Governments didn't know how far it truly extended, only that the balance of financial power had just shifted. Banks in Singapore and Johannesburg were the first to flag settlement anomalies when yuan-denominated transfers cleared faster than the usual cross-border timeframe, a change senior traders attributed to upgrades inside China's cross-border interbank payment system. Financial Times coverage last month detailed how quarterly CIPS transactions have climbed to nearly 13 trillion yuan, a level that reflects a multi-year shift toward yuan-based invoicing in energy, metals, and intermediate goods. This acceleration aligned with a separate warning from the IMF's October outlook, which noted that emerging economies were increasing their exposure to non-dollar payment channels at the fastest pace since 2014. The pace of movement created a measurable impact inside Africa's development finance community, where Reuters reported in late September that Kenya, Angola, and Ethiopia renegotiated portions of their external debts into yuan structures to reduce exposure to U.S. rate volatility. Kenyan Treasury officials explained at the time that dollar-denominated liabilities had become increasingly difficult to manage as global funding costs rose, and China's policy banks offered more predictable repayment terms in local currency equivalents. This was preceded by Angola's announcement that it had linked its state oil companies' contract settlements to a yuan-based mechanism to stabilize fiscal outflows. Trade ministries across Southeast Asia signaled similar motivations when, earlier this year, Indonesia issued its first offshore yuan bonds. Bloomberg data showed that the three-part offering reached an order book of more than 3 times the available supply, drawing demand from regional funds seeking more direct exposure to Asian credit markets. Officials in Jakarta said the shift allowed the country to diversify beyond dollar markets, which had become more sensitive to Federal Reserve tightening cycles. The offering followed a series of bilateral agreements in which Indonesian state-owned enterprises began settling coal and palm oil shipments directly in yuan. A month later, the Bank of Korea and the People's Bank of China renewed their currency swap line worth the equivalent of nearly $50 billion, a move the Wall Street Journal said offered Seoul a buffer against foreign exchange volatility during periods of geopolitical tension. The extension came at a moment when Korean manufacturers were expanding production of intermediate semiconductors destined for Chinese supply chains, making currency stability a strategic priority for exporters. South Korean trade officials added that the swap line created operational flexibility for firms transacting heavily in East Asian currencies. Further pressure built when South Africa's National Treasury confirmed that its development projects would begin receiving financing through yuan-denominated BRICS mechanisms. Reuters reported this in mid-October, noting that the arrangement would be directed toward logistics, electricity infrastructure, and water management. South African officials said the structure lowered exposure to exchange rate swings that had hindered earlier dollar-based financing agreements. The news coincided with South Africa's central bank increasing its yuan reserves to diversify its currency holdings. In the Middle East, energy markets saw a shift after Bloomberg reported that Chinese refiners had settled an increasing share of crude purchases from Gulf producers in yuan. Traders in Dubai said settlement data showed a steady rise in yuan usage for petrochemical feedstocks. The trend gained momentum after China and the United Arab Emirates launched a yuan clearing arrangement earlier this year to streamline trade flows for metals, energy, and transport equipment. UAE officials told the Financial Times that clearing in yuan reduced transaction friction for exporters with strong links to Chinese markets. Latin American governments tracked the same pattern. Argentina, facing a shortage of trade settlement dollars, tapped its yuan swap line to cover import costs, according to Bloomberg's reporting in April. Central bank data from Buenos Aires showed that the facility was used to settle payments for machinery, electronics, and industrial inputs sourced from China. Brazil, meanwhile, finalized a direct yuan settlement channel last year, enabling companies to settle trade without converting through intermediary currencies. Brazilian banks told Reuters that the mechanism shortened processing times and reduced hedging costs for local firms. The escalation continued when China's currency appeared more frequently in global trade finance metrics. Swift data cited by the Financial Times showed the yuan's share of trade finance rising to around 7% in September, up sharply from levels 3 years earlier. Analysts noted that the increase came at the expense of the euro and the yen, both of which saw declining shares. The dollar remained dominant, but the data pointed to an evolving trajectory shaped by diversified settlement channels. The strategic backdrop shifted again after the Bank for International Settlements released updated tables showing that cross-border yuan lending to developing economies had risen by more than $300 billion equivalent over the previous 4 years. Officials at BIS said the increase reflected sustained demand for credit linked to infrastructure, telecommunications, and transportation projects. Borrowers in Central Asia, according to BIS country-level notes, were among the most active users of yuan-denominated loans. A closer look at China's overseas balance sheet revealed that foreign-held yuan deposits and bonds had climbed to the equivalent of more than $400 billion, based on Bloomberg's compilation of People's Bank of China data. Traders in Hong Kong said that offshore yuan liquidity had broadened substantially as institutional investors sought alternative yield sources amid uncertainty in global bond markets. The demand had encouraged several European companies to issue yuan-denominated bonds to gain access to Asian capital pools. While these developments unfolded, the IMF's quarterly reserve data showed that central banks were gradually increasing their holdings of non-dollar currencies. The fund noted that the collective share of reserves held in alternative currencies had reached levels not seen since the early 2000s. The report emphasized that diversification did not necessarily reflect a rejection of the dollar, but rather a strategic reassessment by reserve managers in response to shifts in trade patterns and geopolitical dynamics. The situation grew more complex when European banks began adjusting their internal risk models to account for higher volumes of yuan-settled trade. Financial Times sources at major banks in Frankfurt and Amsterdam confirmed that risk committees were recalibrating hedging models to reflect increased exposure to East Asian currencies. The adjustments coincided with rising euro-yuan swap volumes reported by Bloomberg's derivatives desk. The dollar's position remained firm in global markets, but the proliferation of bilateral swap lines, direct settlement channels, and alternative clearing networks added layers of competition. U.S. officials noted during recent briefings that dollar demand remained central to global finance, but analysts acknowledged that a long-term structural trend toward multipolar settlement systems was underway. One strategist at a major U.S. bank told Reuters that the shift was slow but persistent, shaped by regional trade blocs optimizing for cost, speed, and political alignment. As the global landscape adjusted, India expanded its own non-dollar settlement mechanisms, offering rupee-based invoicing for select partners. Reuters noted that Indian exporters increasingly used rupee trade to offset dollar shortages in certain regions. While India maintained complex ties with China, its move reflected a broader trend of emerging economies pursuing diversified channels, rather than relying exclusively on dollar-based systems. Meanwhile, Russia accelerated its integration into yuan settlement networks as Western sanctions constrained access to dollar and euro channels. Bloomberg reported that more than a quarter of Russia's import and export settlements were processed in yuan, a dramatic shift from 2 years earlier. Russian banks linked to CPS added redundancy to their payment pathways to maintain access to international trade under restricted conditions. The convergence of these developments created the backdrop for the BRICS announcement that unsettled markets earlier this week. Even though the stated figure of 185 countries reflected political framing rather than verified deployment, the assertion drew attention to the underlying reality. Multiple regions were already integrating elements of yuan-based settlement architecture at a speed that exceeded earlier forecasts. Analysts told the Financial Times that narrative pressure often plays a role in accelerating adoption when countries perceive strategic incentives to diversify. Inside Washington, the Treasury Department acknowledged the need to monitor how alternative settlement channels could influence demand for U.S. securities. The Wall Street Journal reported that foreign holdings of U.S. Treasury debt had experienced moderate fluctuations this year as certain emerging markets expanded their use of local currency financing. The U.S. remains the world's largest bond market, but changes in global trade settlement patterns can influence long-term reserve allocation strategies. Even within dollar-dominant commodity markets, subtle adjustments were underway. In metals trading, several Chinese exchanges expanded yuan settlement options for copper and aluminum, responding to rising demand from regional buyers. Reuters data showed that Asian importers increasingly opted for yuan pricing when dealing with Chinese suppliers, especially in intermediate products where supply chains were deeply intertwined. The chain reaction reached a new stage when South American agricultural exporters began experimenting with yuan invoicing for shipments to Chinese ports. Bloomberg reported that soybean exporters in Brazil and Argentina were exploring options for yuan-denominated contracts to reduce currency volatility during peak harvest seasons. Traders said the shift was driven by timing advantages linked to China's payment processing hours. Across the global south, financial ministries emphasized that diversified settlement channels reduced exposure to political disruptions. African officials told the Financial Times that broader access to yuan loans and settlement mechanisms provided insulation against abrupt swings in global funding conditions. They argued that diversified settlement systems offered countries greater autonomy during economic shocks. With markets trying to interpret the scale of BRICS ambitions, one fact remained clear from the most recent IMF, WTO, and SWIFT data. The infrastructure for multipolar currency settlement was expanding faster than earlier models anticipated. Each data release added another layer to the shift, and each shift raised new questions about long-term dependencies. When currency desks closed for the week, traders remarked that the BRICS announcement, even if partly symbolic, had exposed an underlying development. The world had moved further towards settlement pluralism than many policymakers had assumed. And as liquidity screens dimmed, one open question hovered over global markets, unanswered and uncomfortably relevant. If the next major trade shock arrives amid this transition, which currency system will absorb the blow first? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.